Welcome to Surgeon Syndicate. If you're paying attention, you know that you only make money when you work. It might be great money, but it's dependent on you. The information on this podcast will help you solve that. We interview experts and provide analysis into financial freedom through commercial real estate. Why? To help physicians like you thrive. Let's dive in.
Welcome back to Surgeon Syndicate. This is your host, Dr. Michael McManus, and we are here for the second half of our conversation with Randy Smith. Randy, welcome back.
Glad to be here, Michael. Thank you for having me back. It must have gone okay on the first one, I guess.
It seems good. I think the listeners are going to enjoy this discussion. So what I wanted to get into, we were talking about illiquidity and how things can change and making decisions out of fear, which is really an interesting thing that's happened with people investing in syndications recently. So if we go back to 2022, so 2 years ago, for people who were investing in real estate syndications, we were almost like, it was like the fevered pitch of the dot-com bubble, that everybody was seeing great returns, everyone was promising great returns, and it was like, oh my goodness, I got to get in on this.
Yeah.
And as often happens, turned out to be not the greatest time to invest, because I know people who have never invested in real estate, but in 2022 were all about it. And now today, people are, everybody I talk to, they're like, oh, I don't know, you're doing that now. That sounds kind of dangerous. That's scary. I've seen the headlines. We're looking at, the million different things. We're going to have a recession, interest rates, looming debt bubbles, all these different things that sound really scary, but maybe now's a better time than 2 years ago to be investing.
Yeah.
So tell me a little bit more about where you see this market right now. If I called you and I'm like, all right, Randy, I got some money, but I was watching the news and I don't like what they said.
Yeah, I think it's everybody knows what sells on news is fear. So if there were a news channel that was based on all good news, it would get no advertising and nobody would watch, and they'd be out of business very quickly. So we know what sells in news. Now, what is interesting is the people that are talking about all the negative things that are going on in this space are talking to people that invested at the very top of the bubble, that were buying assets at a time when the math didn't make sense. The economics behind the purchases did not make any sense at all. People were buying primarily based on expectations of appreciation, and interest rates are going to remain like they are back in 21, 22 forever. And the smarter money knew that was not the time to be buying. And there was a very large amount of capital that was sitting on the sidelines throughout all of that. And it was interesting. You would hear, if you listen to podcasts at the times, you had these operators that were talking about, it's the hottest real estate market ever. We're flipping these deals in less than 2 years, sometimes less than a year, and doubling people's money. And the expectation was that was going to continue on forever after. And anybody who's been through numerous ups and downs in the market knows that like a market like that cannot continue forever. So with that being said, there are a lot of deals that are upside down now. There are a lot of operators that are bleeding prints or bleeding dollars and having to reinvest additional dollars out of their pockets. And there are investors that are losing money on investments today. You see that quite often in the news. Now, the reason those investors are losing money is because a lot of the assets that are being sold today are having to be sold because those operators got bad loans on those deals back in 21 and 22, which put them in a position where either one, they're being forced to sell today because of their loan expiring, or two, when they got the loan, they didn't get rate caps on those loans that they bought. So it's creating this environment where if they're bleeding money every single month, at some point, they're just going to hand the keys back because they're going to run out of money. or two, they're having to sell and the banks are taking these assets back at the loan value, which means the LPs don't get any of their money back. So all that to be said, if the value of assets have dropped by 20 or some will say 25%, then now is absolutely the time to buy those assets if you can cash flow on those with the correct debt today. So what I'm personally seeing is that the deals that are coming across my desk today are underwritten much more conservatively than they were 2 or 3 or 5 years ago. They're cash flowing from day one. More often than not, they have fixed rate debt or they've been able to manufacture fixed rate debt with rate caps. And if nothing changes, these things will still be good investments. If rates do drop, then these have the potential to be home runs again. So, as they say, when other people are, what do they say? When people are fearful, it's time to be greedy. And when people are greedy, it's time to be fearful. Well, people are fearful today. So my advice is now is the time to buy.
Because a couple of years ago, it looked like when you listen to what was going on, like you could throw a dart randomly and it was going to be a great investment. Or actually finding the great investments then was hard and maybe was a better time to sit on the money. And that was hard when, you put your money in a bank account and you got 0.1% interest.
Yeah.
It was hard to sit and watch assets appreciate. But now there's a lot of talk of bad, but if somebody's figuring out a way to get a deal done, it's harder to mess them up now. And the banks are the lending environment is so tight that the banks are part of the gatekeeper there, because if you got the deal past the bank, you've done a lot more right, where a couple of years ago, they were just throwing money around going, hey, you got a deal? Let me give you some money.
Absolutely. Yeah. And, it's interesting. I used to use that argument as well, that if the banks are approving these loans, they must be solid. But there were banks approving those loans back in 21 and 22 as well. And, they would sell these loans and then sell them off, or they would take on these loans and then they would sell them off to other operators. So yeah, it's interesting that we got ourselves in this situation again, quite frankly. I'm shocked that there were banks willing to do floating rate loans at the height of this, but there were a ton of them. And we're seeing the results of those today as some of those, unfortunately, investors are losing money. And that will be lessons that are hard learned for a lot of folks.
It is always such a hard thing that when everybody's jumping in is the time to maybe stop. Yeah. And when everybody seems like they're running away is probably the time to get in. Yeah. Because it's a lot harder. Yeah, it's a lot harder to lose all your money if you make a deal work today than it was a couple of years ago. So, so on this idea of evaluating operators and finding operators who make good decisions, what are some of the things you look for? What's your process of, somebody calls you and says, hey, Randy, raise me $1 million for this deal. What's your process there? Let's say you've never talked to them before. They heard about you and they said, hey, will you help me raise some money? What's your process to vet them and the deal?
Yeah, good question. And I think that's probably the most important question your investors should be asking as well, is why this operator, why this deal? And fortunately, I think if you vet the operator, odds are the deals that they're finding and putting in front of investors are going to be good deals. So first and foremost, I always look at track record. How long has this group been in place? How many economic cycles have they been through? How many full cycle deals have they been through? How many times have they executed the business plan that they are projecting to do on this specific asset? And that single piece of due diligence, I think, rules out 80% of the players that are out there, because most of the folks came into the space in the last handful of years. A smaller group of those folks have actually done full cycle deals, and an even smaller group of those have kind of net the other expectations that I'll kind of lay out here. So, first and foremost, what kind of track record do they have? Now, I will say on one caveat that I think track record follows an individual prior to industry. So like yourself as an example, you've got a long track record of being a performer in your medical field, and now you're in this space. So maybe you've only been in real estate for 2 to 5 years, but if you've been a performer in previous roles in your career, my belief is top performers continue to be top performers regardless of what they do. So I think it's important to look back at that as well. So after you've figured out the track record piece and you understand whether you're dealing with, basically somebody who can achieve and perform at a high level, then I like to dig into what the assumptions look like that they're using in their underwriting models, and what type of lending tools are they using? Are they using fixed rate debt? Are they using floating rate? Do they get rate caps? Are they using a 5-year fixed rate debt, 7-year, 10-year fixed rate debt? All of those different types of things. Those are critically important. And then I like to dig into their underwriting model and take a look at their assumptions. So, are they a group that is expecting to see rental income increase 5% year over year moving forward? If they're putting that in their underwriting model, I'm going to be concerned. If they're even putting 3% year one, I'm going to be a little concerned in today's market. And then looking at exit cap rate compared to cap rate on the purchase, I think are all really, really important things. And one recent one that I've just started adding into this is because I've been in the space now for a number of years, I'm starting to build a reputation and a brand. I've personally made the decision where I'm only going to work with operators that have at least 500 million in assets under management. So it's a track record, qualification, but it's moving more towards a volume piece as well. So my goal is to work with only the biggest and the best operators out there. So I have the luxury, having had some success in the space, where I can really pick and choose the operators that I work with. So
that's a nice place to be. Any things that for you are a big red flag, whether you're investing or you're just talking to somebody that you're like, oh, this is somebody I wouldn't put money towards.
Yeah. So, in any one of those categories, those are all red flags, the opposite of what I'm looking for. I like to see cap rate expansion in underwriting models. I want to see conservative changes in the cap rate as well, albeit not as strong as what we might have saw even a couple of years ago. I personally like to see rent increases and expense increases very close. So maybe 3 and 2 or 2 and 1 even. If ever I see folks that are underwriting lower expenses than what the asset was operating at before, I'm always concerned about that. I want to hear why they think they can operate this asset better than the previous owner. Because I've seen it so many times where, they'll shave off X percentage of the expense off the T12 because they're such a premium operator. Well, I don't have any reason to believe that you are, because those folks owned the asset for 15 years. Why do you think you can operate it better than them in year one? So those are some of the things that I look for, but just really digging into the underwriting and taking a look at the assumptions that are in there, and then asking questions about things that concern you. If you see insurance in a lot of markets and taxes are really big things. So make sure that they understand where they're getting those numbers from, that they're not just, picking those out of the sky, because those are two areas that'll just crush an underwriting model if not taken seriously.
We'll get back to our show in just a minute, but first I want to offer you an opportunity to accelerate your learning. My life changed, and my ability to start becoming work optional changed when I gained the people and the knowledge to start investing in commercial real estate. One of the key people there was Ash Patel, and joining his Invest Beyond Multifamily Mastermind. Well, that mastermind is no longer open, but for a fraction of the price, Ash has now made a course. And this is probably the most valuable set of information and quickest way to move along your learning curve. So if you are interested in actively investing in commercial real estate and retail and industrial and office, I would recommend this course to you. We're going to include a pre-sale link both in the show notes. It'll also be on the surgeonsyndicate.com website. And in your checkout, I'll save you another 1%. I know it's not a lot, but every little bit helps if you use the discount code Mike1487. If you're not interested in investing actively, give us a call here at Fortress Capital, and let's talk about what your goals are as a passive investor. But it's time to stop listening, start acting, and let's move your future forward.
Some of those things you were just talking about, it's, even I think when you talk about success in the past as a surgeon doing real estate, as I look at it a lot like when learning surgery, you go through residency, there's somebody showing you and then somebody looking over your shoulder. And I feel the same way about when I do a deal now. Like I kind of look and go, how could I screw this up? And who do I need here to make sure I don't?
Right.
Looking at the team. And that was kind of the way I approached surgery earlier in my career too, is you look at going, okay, what could go horribly wrong here? How do we stay out of the horribly wrong space? Right. And if you're having a hard time, if that's a hard answer at all, who do I need here to either keep us out of trouble, or if we get into trouble, that it's not going to be horrible trouble? And I guess that's, the ultimate one as a urologist earlier in your career is if you have a big kidney tumor and it's invading into the big blood vessels, well, we don't operate on those big blood vessels all the time. Some urologists have, some later in their career are fine, that if you need to sew up the vena cava, it's no big deal. But if you're not there, you have to look at yourself honestly and say, hey, Mr. Vascular Surgeon, will you come hang out for a little while we get through this tricky part? Because that person does it every day, and it's not going to be a big deal if you need them. And so I think, I look into the deals I'm looking at, especially ones for myself, and I say, who do I need here with me that has been here 100 times, who's not going to be surprised by anything? And then the last part you were saying was, the taxes. Just yesterday, we were looking at a deal, and it was one that had been owned for 30 years by the same guy. And we're looking at the tax base on it right now, and the purchase price could be 3 times where it's assessed at. And if they do the same thing to the taxes, if they increase taxes by 300%, all the profit goes away. It just vanishes instantly. So it becomes a tricky thing. And that was weird. I was on the phone today with the assessor in that town. And because of the way they do their assessments in a lot of places, that can be a hard question to try and wrap your head around. And so I think that's one that we're having to put in the underwriting model. Okay, let's write in that 300% increase, a tripling in the tax bill. Is this still worth doing? Or what else needs to happen now to make this worthwhile, so that if the taxes go all the way up, it's still a deal worth being in. If they don't, it's a great deal. And you don't know. They even told me, I talked to the assessor, and he's like, well, here's the way our model works.
Gosh.
And I can't tell you. He goes, I know there's other places that it's easier, but we go back and retroactively look at all the sales. And I don't know where all the sales are, and if yours is out of line with the other sales, and what time of year you buy it, it might come in wrong. And so we had this 20-minute conversation around their model, which I reasonably understand now, but the whole thing came down to, in reality, it probably won't be a 300% increase, probably be a 50% increase, which is still a pretty good chunk.
Sure.
But you got to write the 300% into the deal. And if you're not willing to do that, then you're risking everything right there on the roll of the dice that some panel. And he said that, he goes, and a lot of times you can come and you can ask him to redo it, and you can, refute the appraisal. He goes, but the first question is always going to be, what did you pay for it? And why did you pay that?
Right.
And if I paid that based upon the rental income, and that's what I paid, fully knowing, and it's hard to even said, he goes, as a commercial investor, you're going to get no leeway with the committee. Grandma bought a house. Yep. First home buyer. Yep. They're going to, they will have pity on you and they will reduce your taxes almost always.
Right.
You, nope.
Yeah. And I think that is a perfect example of why you work with operators that have track records, because they've had that conversation 100 times. They probably have assets in the area, so they know exactly how it works in an application, and there's less surprises, right? It's hard for the newer guy getting started because he doesn't have those reps, but that's why it's so difficult to get into the space, is that things exactly like this. So that's a good lesson, definitely.
Yeah, I learned an interesting thing yesterday. I'd heard this like a year ago, but now I see people doing it regularly, that they now own a drone. They know how to fly it. And before they even go under contract, they've got the drone up, looking at the roof, looking at the AC units, looking at all the stuff that's hard to see, and at least getting a preliminary impression that, why bother if, and for a commercial building, if you've got $500,000 in roof repairs,
right,
and you're just nowhere close on that deal, then stop wasting your time. You can put it away. Done.
It disqualifies a lot of deals quickly, right?
Yeah. Before you have to bring out the roofer, before you bring out the HVAC, before you do the full inspection and due diligence, it's a real quick. I bought a $300 drone. I learned to fly it. And now I can go look at all this stuff and get an initial jump on if it's worth my time anymore.
Nice.
And time's important because that's where you find deals. If you don't, we're okay on the time. We'll see if they edit that out. So,
got it.
So I thought you needed to go. So hopefully we'll edit this out. If they don't, for everybody listening, this is sometimes what we get into in our podcasting is that we record on Zoom, and some Zoom accounts, you get an hour limit, but ours is set up so we can keep talking if we're having a good discussion.
Very good. Very good.
So this is all going on in the background while we're trying to talk. So, all right, we are getting close to the end here. Anything when you deal more with sales professionals, as that's kind of your niche, but everybody's niche overflows, because our avatar for this show are surgeons, but I know we've got people listening who aren't surgeons because they've talked to me about it. What are your any advice for doctors, especially if they're, and maybe this applies to everybody, if they want to get started in investing in real estate, but haven't done it yet?
Yeah, I think the biggest thing with anything is taking action, right? So if you're a high income earner and you have started maxing out your 401ks or your other retirement accounts, and you're starting to accumulate dollars in other type of investment accounts, I think it makes sense at a minimum to take a look at your portfolio and decide to at least hold a portion of your investable capital in real estate. If you look at most all the wealthy people in the world, they've either gotten wealthy or have maintained their wealth or grown their wealth through real estate. It's really unquestionable as to whether that's the case or not. Like, everybody who has grown or accumulated any significant amount of wealth owns real estate. So consider what that percentage might be. And it could just be 5% or 10% of your investable capital that you want to allocate into this space, and then get on the phone with a bunch of different operators and pick somebody who you feel comfortable with, that will answer your questions and hold your hand through that first investment, and then place the minimum investment in one of those deals. And, the experience that I found is that anybody that starts investing in this space and they pick a good operator and they find a good deal, that percentage of investable capital that they're placing into real estate will continue to increase more and more every year. So I just encourage folks to take a look at that, and at a minimum, consider a small portion to put in this space. And I think you'll be convinced it was a good idea after you get started.
That's a great lead in. Every time somebody's talking about that, I keep coming back to this thought that, for the high income individual, if you are a spouse or a partner of a high income individual and you want to look at this space, talk to your tax professional about the real estate professional status. This doesn't mean you were becoming a real estate agent. You could, but there are criteria about how much time you spend on real estate. It gets a little more nuanced when you're just doing passive investments because you have to have a certain level of involvement. But the cool thing about it is there's a lot of depreciation in real estate that is tax savings. And for the most part, that only goes against long-term capital gains. But if you are a real estate professional, it can go directly against W-2 income. And so for people that I know who are married to a high-income individual, just the tax benefits alone of even a deal that didn't turn out that great can have a significant impact. And so this is educational. It's not tax advice. We'll give the disclaimer there. But
of course,
if your accountant or your lawyer, or whoever you do your tax planning with, has no idea about this, find somebody else and ask them about it. Because when I look back to when I finished residency, if I had had somebody come and say, hey, if you do this, the impact it would have had over the last 15 years is painful. Is what it is.
Yeah, it's painful
to have not had it. So just one other way to get into it and de-risk it, because you start saving money on your taxes, and that already means that your returns are up from day one. So,
and Mike, to kind of add on top of that, the year I left my W-2 is my single largest income year of my life, of my career. And because I was able to designate as a real estate professional that year, my federal income tax was less than 4% after we factored in all of the passive losses and the rep status. So it was my highest income earning and by far my lowest tax bracket I had ever been in. So
that's a good year.
That's a good year. From 37.5% to 4%, that's a good transition. So yeah.
The last one I'll throw out there, because it's where I met Randy, is groups that give you a network to learn about these things from. So we met through a group, GoBundance, not a sponsor. It is a recommendation. It's a great group. But in there, you meet people who are doing this, people who can help educate you, people who it becomes a normal. I keep coming back to this because I just listened to this book called This is Marketing by Seth Godin. And he talks about, he says that when people think about what they do, they go, what do people like me do? Mm-hmm. And for the average doctor, people like me don't invest in real estate. And so you surround yourself with different people who it's a normal thing to do. Yep. And not only, so that gets rid of some of the emotional fear, but also people who can say, you can have these conversations all the time about good decisions, bad decisions. It's a huge part of moving forward. Don't do it alone.
I love it. Great advice. Yeah, thanks for sharing. I think that getting around a tribe that is continuing to push and learn and educate themselves in areas where they might feel uncomfortable has been a really critical part to the success that I've seen, certainly over the last few years, but really my whole career. So.
All right. Well, Randy, if anybody wants to get a hold of you, what is the best way to reach out to you?
So the easiest way to reach me is on LinkedIn. I'm on LinkedIn constantly throughout the day, but you can go to my website, impactequity.net. And I've got a really great podcast that talks about a lot of these things as well. It's called The Gentle Art of Crushing It. And my Thursday edition is solely focused on the new or newer passive investors. So yeah, come join us.
All right. So we should get all of that in the show notes for everybody's reference. Randy, thank you so much for being here.
Thanks so much for having me, Mike. Yeah, this is a lot of fun.
It was great. And for our listeners, thank you for joining us. I hope this has added value. And please join us again here on Surgeon Syndicate.
We'll get back to our show in just a minute. But first, I want to offer you an opportunity to accelerate your learning. My life changed, and my ability to start becoming work optional changed when I gained the people and the knowledge to start investing in commercial real estate. One of the key people there was Ash Patel and joining his Invest Beyond Multifamily Mastermind. Well, that mastermind is no longer open, but for a fraction of the price, Ash has now made a course. And this is probably the most valuable set of information and quickest way to move along your learning curve. So if you are interested in actively investing in commercial real estate and retail and industrial and office, I would recommend this course to you. We're going to include a pre-sale link both in the show notes. It'll also be on the surgeonsyndicate.com website. And in your checkout, it'll save you another 1%. I know it's not a lot, but every little bit helps if you use the discount code Mike1487. If you're not interested in investing actively, give us a call here at Fortress Capital, and let's talk about what your goals are as a passive investor. But it's time to stop listening, start acting, and let's move your future forward. This has been an episode of Surgeon Syndicate. If you got value from this episode, you know other surgeons are hungry to become job optional, and you can help them by sharing this content today. Schedule a call and we can make a plan. Looking forward to having you with me on the next episode.